Imagine that, like most Americans, you make a decent wage, but have little in the way of a financial cushion to absorb unexpected expenses. Your car breaks down, and you need $300 to get it fixed. What do? About 20 million Americans last year chose a payday loan as a solution to an unexpected expense. Consider the choice facing a cash-strapped consumer. Borrow from friends or family? Not always a possibility, and not always a comfortable situation. Use a credit card? Possibly, but credit cards carry limits and costly late payment penalty fees. A bank loan? Probably not. Banks quit making short-term loans to instead focus on more profitable bounce check and non-sufficient fund fees. To fill consumer demand, companies started offering short-term loans in the 1990s. The loans were often called payday loans because they were typically due in full by the borrower's next payday. Today, payday loans cost about $15 per $100 loaned for 2 weeks. A loan of $300 carries a fee of about $45, or on an annualized basis, 391% APR. Borrowers use payday loans to avoid more expensive and credit-damaging options, such as bounce check fees, non-sufficient fund fees, and late bill payment penalties. An average bounce check fee of $27 carries an APR of more than 700%. An average late credit card payment fee of $29 carries an APR of more than 750%. A $50 fee for a late utility payment and reconnection fee carries an APR of more than 1,300%. Bounce checks and late bill payments are also likely to damage a consumer's credit rating, so a payday loan is often the wisest choice available. But are payday lenders making ridiculous profits? Not really. Accounting consultants Ernst & Young found that it costs storefront payday lenders $13.89 to offer a $100 loan that carries a $15 fee. Additional research shows that the vast majority of borrowers understand the cost of their loan, are confident in their ability to pay it back, and appreciate having access to a solution that saves them money by letting them avoid more bounce checks. In fact, more than 90% of payday loans are paid off on time. Payday lenders don't charge late fees, and the majority offer extended payment plans as a safety valve for borrowers who have difficulty making their loan payments. These plans provide borrowers 8 additional weeks to pay off what was originally a 2-week loan, with no additional fees. More than 90% of customers say they are satisfied or highly satisfied with their experience, scores that are much higher than those of other retail and financial service categories. In addition, borrower complaints are rare. A recent national survey found only 1,000 complaints from more than 100 million loan transactions. Additional independent research from the Federal Reserve Board, Georgetown University, and others indicates that payday loans are not predatory, and by providing credit where otherwise there would be none, such loans actually help borrowers. Where payday loans have been banned, consumers have bounced more checks, gotten hit with more late bill payment penalties, and filed for personal bankruptcies at higher rates. Millions of hard-working Americans occasionally need a couple $100s to make ends meet. For them, short-term loans can help them save money and their credit score. Payday loans, a necessary product, delivered responsibly to reasonable people.